Welcome to The Explainer. Today, we're doing something a little different. We are peering straight into the darkest, most opaque corners of the global economy. We're looking at a massive, completely hidden structural risk that is just lurking beneath the surface of all your everyday financial news. We're going to unpack a financial shadow so unimaginably huge that it literally dwarfs our traditional markets. We are essentially sitting on a giant precarious house of cards right now, and today, we're going to break down the exact forces that could cause the whole shebang to fold. Let's get right into it.
Okay, let's dive into this. $100 trillion. I really want you to just take a second and let the sheer number of zeros on that figure sink in. According to market watchers and observers cited in our source material, the combined value of derivatives and leverage operating in our markets right now sits somewhere north of this totally unfathomable number. Try to wrap your head around that scale for a second. We're not talking about billions. We aren't even just talking about a few trillion, which, by the way, is the entire GDP of major nations. No, it is over $100 trillion. This is the absolute staggering weight of the invisible money moving through the global financial system every single day.
So, what actually makes up that towering mountain of money? Well, a massive chunk of it simply comes down to derivatives. These instruments basically make up an entire shadow economy that's based almost completely on market speculation. And look, for those of us who follow the markets closely, you know we aren't just talking about your traditional old-school agricultural futures anymore. No, we are talking about credit default swaps, but in entirely new, highly opaque forms. We're talking about exotic Bitcoin derivatives. We're talking about infinitely complex contracts that are essentially just betting on future price movements. It's a core mechanism driving how the modern world economy is just so heavily leveraged through pure speculation, rather than fundamental, real-world growth.
And that brings us right to the engine of this entire machine. So, the crucial point is leverage. You can basically think of leverage as the ultimate amplifying force, the thing that's pushing all of this market speculation way, way beyond that $100 trillion mark. Mathematically, sure, it multiplies your gains, but it dangerously multiplies your losses. And this is exactly why leverage acts like absolute gasoline on a fire in our current economy. It means that even a minor, tiny tremor in the actual physical economy can trigger a massive, disproportionate earthquake in this speculative shadow economy. Which brings us to, honestly, the most unsettling part of this entire situation. What are the actual numbers? The terrifying uncertainty highlighted by our source is that, well, nobody truly knows. And this total lack of visibility is exactly why the Federal Reserve Chair has been under such immense fire lately. It's why he's so heavily weighed down by the prospect of lowering interest rates. He knows that with hundreds of trillions of dollars in leveraged, totally opaque debt sitting completely off traditional balance sheets, lowering rates too quickly wouldn't just stimulate the economy. No, it would throw gasoline right onto this hidden fire. In the world of finance, that kind of blindness to systemic risk is exactly what turns a standard market correction into a full-blown catastrophe.
Now, what's really interesting about this slide is the opposing universes of finance that we are essentially looking at here. On one side of the ledger, you've got this staggering, completely opaque world of global market speculation and massive $100 trillion leverage. And then on the exact opposite side, you have fundamental traditional investing. The kind championed by legendary investors like Warren Buffett and the late Charlie Munger. One universe is entirely based on deeply analyzing a business, actually understanding its cash flows, and creating real, tangible value over long periods of time. The other? Well, the other is essentially a high-wire act. It's based on highly leveraged, very short-term bets on price movements and market volatility.
In fact, our source notes that this shadow economy is built on, quote, things that Charlie Munger and Warren Buffett would never even think of investing in. And I think this just brilliantly illustrates the danger here. When two of the most historically successful and deeply informed investors on the entire planet deliberately avoid this entire shadowy realm, that serves as a massive blinking red warning sign for the rest of us, right? They avoid it because the risk-to-reward ratio, which is driven by that extreme leverage and complexity we just unpacked, is fundamentally disconnected from any kind of real-world value or safety.
Which brings us to the ultimate and frankly ominous question posed by our source. What happens if this becomes a world depression or recession? If the fundamental economic pillars actually start to shake, what happens to this massive secondary system that's propped up by hundreds of trillions in borrowed bets? Like we said, we are sitting on a house of cards. And the really chilling reality we have to face is this. What happens when that house of cards folds? What's actually left? Because when push comes to shove, we're definitely not going to be able to just bail out the world for $300 trillion. So I'm going to leave you with this provocative thought to ponder today. When the foundation of the real economy contracts, can a shadow economy of this magnitude actually survive the daylight? Thank you so much for joining me for this explainer. Keep asking questions, keep looking at the structure behind the numbers, and I'll see you next time.